Well, everybody, welcome to Adjusting Journal Entries for Accounting Part 2. This is the big picture, or how our adjusting journal entries fit into our process or processes, wherever we are. Okay, what did we do in the last segment? So if you go back to the orange slides, we're now on the red slides, is what we went through and we did is we recorded transactions. We prepared an unadjusted trial balance, right? We want to make sure that after we've recorded the transactions, our total debits equal our total credits. We then prepared an income statement. We then prepared a statement of retained earnings. We then closed out our temporary accounts to retain earnings. What's a temporary account? Revenues, expenses, and dividends. It shows what we've earned or what we used during a period of time, including what we gave back to our shareholders, which is our dividend. We then prepared a post-closing trial balance. It's not post-Malone. It's after we've closed out the temporary accounts to retained earnings. Remember, retained earnings is the linkage between the income statement and the balance sheet. We prepared a post-closing trial balance, and then we prepared a balance sheet. We want to make sure that our total assets are equal to our liabilities plus our total owner's equity. Now, for this segment, it's exciting. What are we going to do? Well, the new stuff is going to be in red, just like these crazy red slides on Google Slides. So right over here, what we're going to first do is we're going to record transactions. What we're then going to do is we're going to prepare an unadjusted trial balance. So those are exactly the same. Then, with additional information, we're going to be going through and looking at the 4 questions that I mentioned previously. Do our expenses reflect what we've used? Do our revenues reflect what we've earned? Do our assets reflect their future economic benefit? And do our liabilities reflect our future obligations? After we've gone through and done that, we're going to prepare an adjusted trial balance for those adjustments we've gone through and have made. Then it kind of looks the same. We're going to prepare an income statement, statement of retained earnings, closing out temporary accounts to retain earnings, preparing a post-closing trial balance, right, to make sure our total debits equal our total credits. But then we're going to prepare a classified balance sheet. What is a classified balance sheet? It is not Edward Snowden. I'm going to show you really quickly. So this is Apple Computer. Got it. I'm dating myself. It's Apple Inc. So this is Apple Inc. And if we come down over here and we go to our balance sheet, I am dating myself. And if we come right over here, what is a classified balance sheet? Well, we're going to classify our assets as current and non-current. Does current mean electrified? No, it means we're going to use them within the next year. So things like cash, marketable securities, as long as I can collect them in a year, accounts receivables, inventories, all of those are going to be current assets. Non-current assets are those we're going to be using over multiple periods of time. If we have property, plant, and equipment, and it's not a 7 Series BMW, ooh, too soon? I don't think so. BMW Ultimate Depreciating Machine, Break My Wallet, and the Bavarian Meat Wagon. I'm not even sure if they're making 7 Series anymore, but I'll let that be said. I'm not disparaging them. I've just suffered. Okay, so right over here, we've got our non-current assets, or those assets that are going to give us benefit for more than a year, or more, basically a longer period of time. These marketable securities are going to be securities we're not going to be collecting, or that they're not going to mature for beyond a year. Remember, it's a year from the balance sheet date. Over here, our current liabilities are those obligations we have to settle within the year. So over here, accounts payable, other current liabilities, deferred revenue, commercial paper, and term debt. When I come down here to non-current, those are due beyond a year. So Apple owes $106,629. No, it's in millions of dollars. This is $106 billion. So when we look at a balance sheet and we're talking about a classified balance sheet, all we're really doing is we're looking at our assets and liabilities on a current versus non-current basis. Our statement of our shareholders' equity that's down here doesn't change. It only impacts assets and liabilities. And it's really about that year from the balance sheet date. If it's due within a year from the balance sheet date, it's going to be a current liability. Due within if I'm going to receive the benefit of it from a year, a current asset. Everything else is going to be non-current. So that's it for this video. I want to thank you. Please feel free to leave your questions below, and I appreciate your liking and subscribing. And I look forward to seeing you on the next video. Have a great one.